firstly, on the lending side, as you know, both CMBS and balance sheet rates have gone up significantly since last year. Balance sheet has kind of lagged CMBS market, but that's going up as well. And so I think that's kind of recalibrated people's expectations. Unfortunately, I think, well, maybe I should take that back, but I would say that values have not kind of recalibrated at the same extent as yet. They're being a little sticky, even though interest rates have gone up significantly, risks have gone up significantly. Values are still kind of, and I think maybe that's sometimes the appraisals are a lagging indicator, and they're based on historical data, so they're really not great for projecting what actually is happening in the spot market for values. As I mentioned, for values, spot markets, really transactions that are happening, but those have really fallen off a cliff. So there's almost very little, like investment sales markets really fall, so it's difficult to kind of see what is happening. So given this uncertainty of where values are, I would suggest, we focusing really on debt yield and DSCR rather than LTV in the current environment. And look, this is going to impact borrowers, right? Because they're used to seeing leverage, and if they see loans at 55% LTV and they were getting 70% before, you get this kind of pushback from them. But we're really focused on debt yield and DSCR based on this new normal of interest rates and what's happening on that front. And so our concern is more on that. And unfortunately, since prices haven't recalibrated, it looks like a really low LTV. So that's I would suggest focusing really on that. I would say you should assume really higher long-term interest rates as a base case and ensure you have kind of sufficient DSCR cushion. And I would also say in this situation right now, given the uncertainties going forward, you want to also plan for a downside that's maybe of a more severe recession and test your cash flows cushion that you have there. If rents decline, if vacancy increases, see if you can really sustain your cash flows, your property can still sustain DSCR on those situations. Also, I think in a situation like this that we've kind of seen from the previous global financial crisis is borrower liquidity, right? That's really important to carry property through, potential recessions. And we've seen that in the last global financial crisis. You had good properties, short-term liquidity issues for a year or 2 years, and the property performance comes back after that. But if borrowers just don't have liquidity to even sustain themselves for 2 years, it becomes challenging. So I would say focus on liquidity of borrowers, forecast a potential 1 or 2 year, recession in the short run, which may happen, and make sure you have good cash flow cushion on that. And I would say if you're kind of doing transitional lending right now, multifamily lease up or something like that, then, you really want to focus on, making sure you get taken out, your takeout financing at maturity, when the asset is stabilized on a pretty, I would say conservative, stabilization numbers. You want to make sure, and then, focus on it. Can your takeout financing at a higher interest rate and some amortization, sustain does your DSCR work at that point, right? I think that's a pretty significant focus that, we should look on. And it's basically recalibration of where we think the takeout financing is going to be, much higher interest rates and, some amortization.